Thanks for joining us today on Market Call. I'm Morella Fernandez. Bruce Campbell joining us on the show. He's president and portfolio manager at StoneCastle Investment Management. He'll take your questions on Canadian stocks today. Here's how to reach us. 1-855-326-6266. Email your questions in if you'd like. Market Call at BNN Bloomberg.ca. Bruce, good to see you, and thanks for joining us today.
Yeah, thanks for having me on today.
What a wild day. West Texas Intermediate shooting up yesterday, still going up today. How often does does oil or West Texas or Brent shoot up this way? How often does it happen?
I mean, we haven't seen too many like this. If you go back in history and look at where it is from just a pure standard deviation standpoint, it's over a four standard deviation move, which hasn't happened really anytime in the past probably 50 years. And so it's a fairly significant move for sure, and it's not one that isn't historic for sure.
Okay, so typically you would see a pullback, but when you look historically, what's the lag time for the pullback?
Yeah, I mean, it really depends. It really depends on kind of what happens, what the result of why we saw oil spike up and kind of when that settles in. But certainly, if you look at it probably over a 3-month and a 6-month period, typically by then it has started to come back down to some degree and is kind of back into what you would consider to be a normal trading pattern.
Okay, so I know you've been watching some indicators and you see some cautionary signals. Can you expand on what you're seeing?
Yeah, we have a dashboard of indicators that we follow, and one of the ones that we look at is something that we refer to as our early warning indicator. And this is something that we get and gives us a signal of potential weakening in the market. And it's not typically right away. It's usually a few months in advance. And about 3 weeks ago now, we saw that early warning indicator turn negative for the S&P and also for the NASDAQ. It's still been strong for the TSX. And so when we see that, it always, kind of the back of our mind is a flashing yellow light. And then we've also seen just last week with the weakness in the markets, we saw the intermediate term indicators that we follow, which are really a kind of a weekly time frame. They turn negative for the S&P and also the NASDAQ. The TSX, though, has still been continuing to be strong. And I mean, that probably has a lot to do with the makeup of the TSX. We see energy in there, we see materials in there, and then even the financials, they've been a little bit weaker the last week, but they've had a really strong year as well.
Okay, so what are you looking at now to look at the next sort of move for the markets, at least in the U.S.?
I mean, one of the things that we want to see is the volatility index. Right now, it's very high, certainly not as high as you've historically seen, but it's very difficult to really be putting new capital to work when you see the VIX at the level it is. We typically like to see it settle down and drop below that 20 level, and then at that point in time, we feel more comfortable putting some of the cash that we have back to work.
Got it. All right, Bruce, let's take a break. We'll line up some phone calls and some emails for Bruce Campbell of StoneCastle Investment Management. Again, he's taking your question today on Canadian stocks. Here's how to reach us. Back in a moment. Welcome back. We will start with an email from Sonny. He has a question today for Bruce Campbell. He says, I'd like Bruce's thoughts on adding a position in CSU right now. I've started to add some already, but wondering if it's a good time to accumulate on pullbacks for a longer term, 3 to 5 year gains. I feel like it's been unduly punished year to date, and we know they just reported and beat analysts' estimates, but shares are down today, 4.5%. Bruce, and part of that is software. Part of that just might be the whole pull down in the market. But what do you think?
Yeah, I mean, this is one of those companies that's been an absolute darling in the Canadian markets. Like, it probably has one of the highest compounding rate of returns over the last 15 years. And the management team has just continued to deliver so solid. And then, if you go back to the fall, there was some concerns that started to rumble around AI and what effects those would have on these software companies. And In the case of Constellation, I think it's probably really overdone. I mean, you saw the earnings today and they continue to be strong. But if you look at what their model is they really go out and make acquisitions. And when they make those acquisitions, they then tuck them into their companies, and then they go out and just continue to service those customers and those clients. And in the past, they would have had a much more difficult time making those acquisitions based on cost because the software sector was so hot. They had a lot of competition from private equity. And now with everyone so concerned about AI replacing software, you would think that that's going to mean that they have the ability to make acquisitions a lot cheaper than they have in the past. We haven't bought the stock with the pullback. Typically, we like to see it stabilize and then start to move up on some of the technical metrics that we saw. But certainly, if you're a pure value investor, this would be the time to be stepping in and be starting to build your position, if nothing else, in Constellation.
Did you own it previously and get out of it?
We have, yeah. We haven't owned it for a couple of years now, but we did own it previously several times, probably over the last 15 years.
Got it. Okay. Let's go to our first phone call then, Bruce. Mike's on the line in Toronto. Hi, Mike.
Hi, Bruce. I'd like to ask you about Happy Belly Food Group. I've got a small position. I know you liked it in the past. It's come down a bit. Do you think some of these smaller plays that are more domestic are a little more sheltered from all this geopolitical concerns and might be a good entry point here?
Okay, thank you for the question. Let's pull up Happy Belly Food if we have that chart. Looks like we don't have it. But I know you did like Happy Belly in the past. You still like it now?
Yeah, I mean, they've done an excellent job of building out what they told us they were going to. So Sean Black and his team have really, they really defined what they were going to do, which was going to take this quick serve restaurant model and just continue to buy and make acquisitions of new kind of emerging brands, and then build out those brands and expand them really across North America. And that's exactly what they've done. The stock, you could certainly argue, probably got ahead of itself from a valuation standpoint, but that's because you're looking at the growth that they've had and that they continue to forecast they'll have, and that you have to believe that they'll grow into that. And they really have. On top of that, if you take a look at the incentive program that they have in place, back when the stock was, I believe it was 10 cents, they set an incentive program that if it hit $2, they would receive a bunch of options in the company, and they did hit that $2 level. And now they have higher levels, $3, $4, all the way up to $10. And I suspect that, over time, they're going to do exactly what they said and deliver on that. In the meantime, if you watch the news releases, it seems like they're opening a new store on a fairly regular basis, both in Canada and now also in the US as well. So it has pulled back a little bit. I suspect that has, a little bit to do with market instability here. And as far as it being insulated, yeah, it is North American focused. And so it won't have the same type of geopolitical background and backwinds that you might have with other companies. But keep in mind that it is also the consumer. So if we were to see some type of significant recession because the oil price stayed up here, then that would potentially be hurt as well.
Got it. Okay. It was at 230 start of the year, down to 162 today for Happy Belly Food. We didn't have the chart, so just reciting that. Let's get to our next caller, Rob on the line in Calgary. Hi, Rob.
Hi. Thanks for taking my call. I've been picking away at Exchange Income Corp over the past couple of weeks, and despite a great earnings report a week ago, the stock has given back all of its recent gains and is down again like another 3% today. Is this a buying opportunity, or should I wait a while for this volatility to calm down? Thanks for your advice, Bruce. Have a good afternoon.
Okay, thanks for the question. Bruce, go ahead. What are your thoughts on Exchange Income? It has given up some here.
Yeah, it has pulled back, but I mean, it's done so well, both in the last year and really in the last 15 years. We talked about Constellation being one of the best compounders on the TSX, and I think Exchange, especially when you include the dividend that they paid out over time, would also fall into that same category. And that management team has done such an outstanding job. If you remember what their model is they go out and buy existing businesses, and then they inject capital into those businesses to really grow and expand them. And they've done an amazing job doing that on the businesses that they've bought, but they've also had along the way. It hasn't been a completely smooth ride in that, they have made acquisitions that didn't work out, and they were able to exit those businesses without a lot of damage to their overall company. As far as what we've most recently seen, they saw, like you said, they saw very strong earnings, and the stocks pulled back a little bit. I think there was probably a lot baked into the fact that they've been executing really well. They've made some, nice acquisitions, and they continue to, go from where they were issuing convertible debt to now they have, fully rated bank debt that they've been able to secure and get in place. And so I think there was a lot built into it. If I was looking out over kind of 3 or 5 year time frame, then definitely, you just want to pick away at this and continue to accumulate it, because it has that nice dividend and has also had that fantastic growth profile as well.
Okay, we hope that works for him. Let's go on to Sue in Okanagan. Sue, what's your question today?
Hi, I'm calling about Savaria. I'm wondering if it's a good time to get in right now because it's sold off a little bit. My concern is that when it comes to healthcare sector, I seem to zig when the market zags. So what do you think on the timing of getting into this one? Thank you.
Thank you for the question. Yeah, healthcare's been a bit of a guess sometimes lately. Bruce, what do you think?
Yeah, I mean, it has definitely, the whole sector's definitely ebbed and flowed. And even if you look at Savaria over time, there's certainly been some bigger periods where it was really out of favor, even though they, have built this case and have really been working on this demographic theme, which, they do a lot as far as access lifts and small elevators and that type of product, which as the baby boomers continue to age, they want to be in their own homes, and Savaria sells them a lot of products that would allow them to do that. And there's going to be, probably a constant demographic push there. If you look at the stock, I mean, it does tend to have these, rather significant kind of almost spikes up, and then, pulls back, consolidates, and makes its next move. So if I didn't own it now, I would probably start and look at probably, buying this in thirds, where, I might start a third of my position now, and then a third if it pulled back a little bit more. And then I'd probably buy the third position probably higher than where I bought the first one, just knowing that then you have the momentum there, and it's probably going to be backed based on what they've done from a numbers perspective in their quarters as well.
Okay, we're going to take a quick break, Bruce. We'll be back with Bruce Campbell of StoneCastle Investment Management. Again, he'll take your questions today on Canadian stocks. Back in a moment. Welcome back to Market Call. Let's go to Kat on the line in North Bay, Ontario, with a question today for Bruce. Hi, Kat.
Hi, thanks for taking my call. I'd just like your opinion on Kits Eye Care. Thank you.
Thank you for the question. Go ahead, Bruce. What do you think of Kits? They're out of BC, yes?
They are, yeah. They're out of Vancouver, and I mean, this is a company that, again, you have to look at the management team and really take your hat off to what they've done on a couple of fronts. One is they did this all before, so this is kind of the second time around for them doing this. They had built up a company probably around 10 years ago now, sold it off to a bigger company, and then they started Kits. I think it was probably around 7 years ago now. And they continue to really grow with their online model. And they're growing both with glasses and also with contacts. The interesting thing is that on the glasses side, they've built their own lab now that they have in Vancouver, which allows them to be way more efficient producing and time-wise producing those different lenses that they actually put into the frames and then sell at a discount. They have fairly aggressive targets as far as where they want to hit from a revenue perspective. And I think right now they're laying out a $500 million revenue run rate that they want to hit. And I think at that point in time, you probably would expect that they're going to do exactly what they did with their previous company and sell it off to a bigger manufacturer or a bigger lens company. And in the meantime, they continue to deliver. The stock does tend to be fairly choppy in that when you see institutional buyers coming in, they tend to push it up and push it down. And it also tends to be fairly lumpy around the quarters. So like the last quarter is a good example. There was fairly significant expectations going into the quarter. The stock really moved up. And then they reported their numbers, which were great. and then the stock pulled back, and it's just a function of like the expectations versus the reality. And sometimes they get a little the investors get a little carried away with, kind of how much they expect the quarter to be versus what it actually can be based on, the numbers and growth and acceleration.
Got it. Okay, let's move on then to Alex in Burnaby, BC, with a question today. Hi, Alex. Alex, are you there? Okay, we might have to move on to the next caller. Frank is in Toronto with a question. Hi, Frank.
Hi, Marilla. Hi, Bruce. My question is regarding Rogers Communication. It's been beaten up last a little while, but it's been very resilient and during these crises, Middle East. My question is regarding the stock. I know they're spending less on CapEx as well as their sports assets entity. They're planning on spinning it off sometime in this year. How is it going to affect the parent company? Thanks for taking my call.
Thanks for the question. Yeah, they're putting a lot towards the sports ownership that they have and trying to get some money there. What do you think about that plan, and how do you think it will benefit the company, if it will benefit the company?
When we look at Rogers, it's one that doesn't rank super well in our universe. So when we rank our universe, we have about 1,000 companies in Canada that we like to track, and it ranks sort of in the last few years. It's been definitely in the bottom half, but probably even in the bottom third of our ranks, and that has a lot to do with their earnings acceleration profile. It's come off the bottom here a little bit, and I think that's probably a function of value and really the dividend. Plus, in addition to that, what they've talked about with the sports side, it still continues to be very challenging on the wireless side. And I just saw a report out today which was talking about the fact that the Freedom plans have been really significantly discounted. And I remember that's Quebecor, which is the stock's done exceptionally well, and that's on the back of probably weakness with TELUS, Rogers and Bell. So it's not one that we own right now. We would just kind of stand back and watch it. If you were a pure dividend investor and you weren't concerned about share price, you could probably pick it up and clip the coupons on the dividend. But the way we look at it, we would sort of watch and wait for things to really improve there.
Okay. That was for Frank. Let's go back to Alex. We've got him back on the line. He's in Burnaby, BC. Hi, Alex. Alex, are you there?
Yeah, sorry. For some reason, I keep missing my name. Yeah, thank you for taking my call. My question is on Curaleaf. It had a big spike last year towards the end of the year, and it seems like it's pulling back a little bit now. And I'm just wondering, I wanted to purchase the stock and hold it for maybe about a year or two, and I'm just wondering what Bruce's opinion is on that company. Thank you.
Okay, thank you for that question. So this is a cannabis distribution company. Bruce, do you know it well?
Yeah, we know it fairly well. I mean, it's one of the bigger multi-state operators down in the U.S. And if you remember, kind of what their plan was, is they've gone out and built production facilities or grow facilities, and then the production facilities into different types of cannabis product, and then they also retail that out. And the big spike last year happened when there was all this excitement around cannabis being rescheduled in the US, which would take it from Schedule 1 down to Schedule 3. And as it drops down to that Schedule 3, then the taxation for those companies becomes much more efficient, because right now they pay something referred as tax 280E. It's not the tax 280E, but it's from the tax legislation. 280E is the code. And as a result, they can't write off any of their normal business expenses. And so they pay very significant high taxes. If it was rescheduled, it would drop down. This is something that the market kind of anticipates, and there's been lots of false starts on whether or not this was going to happen. It will eventually happen, I do feel, but that could be 2 months or 2 years or 2 decades from now, and it's really hard to predict. In the meantime, it really tends to jump up and down. These cannabis stocks are not one for the faint of heart. They tend to be fairly volatile. I would look at it as a small position in my portfolio until such time that they actually got that rescheduling, and then you started to see that they would have significant cash flows from their operations, whereas now they pay so much money to the IRS in the U.S. that they really don't generate a lot from a cash flow standpoint.
Okay, and you do feel they're well positioned to benefit when that change occurs in the U.S.?
They are. I mean, they have multiple states that they operate in now. And if you were ever to see actual cannabis changing it the way it has in Canada, then it would be even more beneficial for them because they have the size and they have the access to capital, and it would allow them to probably to grow and to manufacture in certain areas and then ship to other areas. Right now, each state, they have to have its kind of own operating system in each state where they grow it, produce it, and then sell it in the individual state. And it could be much more efficient if they ever saw, cannabis completely reclassified or made legal as it is in Canada.
Okay, let's get to one caller before the break. Elliot's on the line in Hamilton, Ontario. Hi, Elliot.
Good afternoon. Premium Brands Holdings. I gather their warehouses are on the cusp of going online south of the border. So the stock has gone up, but now it's pulling back. I wonder if that's because of maybe oil going up and consumer discretionary taking a hit, or is there something else going on with the company? Please, your thoughts on PBH. Thank you.
Let me ask whether you think consumers are feeling that pocketbook hit from oil just yet.
Well, I mean, they probably have as they hit the gas pumps this week, but that's probably not a long-term effect yet. I mean, it's probably a few dollars compared to the week before or the 2 weeks before when they gassed up. But if it stays, then yeah, it's going to start to have a significant impact because, we saw, probably a 30 or 40 cent a liter jump between, where it was a few weeks ago before, all the trouble in the Middle East started and where it is right now. So that certainly will have an impact. When we look at premium brands, I mean, if you look at the stock chart, it has been, there's lots of kind of ups and downs. The longer term trend has been up. And I mean, this is another company where they've done a fantastic job of making acquisitions, implementing those acquisitions into their company, and then going out and kind of rinse and repeat on that with the next one. And they've just recently made some more acquisitions down in the U.S. and that will be positive for the company. It'll probably take them a little bit longer to integrate all those in. And yes, there is a potential that, if we were to see inflation really start to accelerate, that the consumer will pull back and just not have as much money for discretionary spending as they had before.
Okay, let's take a quick break. We will go through some of Bruce's past picks when we come back. Stay tuned for that. Welcome back. Time for our past picks from Bruce. August 18th of 2025, Bruce, is when you chose the following stocks. Energia at the time was $1.46. It's up to $2.12, 45% upside for a return and total return. Have you held on to Energia? I know it's one, I think you've recommended it more than once.
We have, yeah. We continue to like it. It's, if you look at what they've done there, they just continue to build up their backlog, which has helped them to turn EBITDA positive. And we think that that's going to continue. There's a lot of runway here. The stock does tend to be fairly volatile as we see, again, institutional orders come in, come out of the market. And it does, because it's a little bit thinner trader, it does get pushed around a little bit. But we like the long-term thesis on this company. And then we also absolutely love the execution that the management team has done here since they took over and recapitalized the company.
Okay, so something you've held on to for now. Let's get to your next pick, which is Tenaz Energy. Again, this is from last year in August. At the time, it was 21.33. It is up to 53.32, 150% upside here for both return and total return. Can you remind me about the company and what they do?
They're an energy company, and they focus primarily. They have some Canadian assets, but they focus where the majority of their assets are is over in the Dutch North Sea, and their European gas assets. And the structure that they were able to do in order to buy these assets, they effectively paid for the assets with the cash flow of the assets because of the timing between when they announced a deal and when they actually had to close on the deal. And this is Tony Marino, who used to be with Vermilion Energy. He started or came over to this company several years ago now and has been making these acquisitions. He's made two fairly significant acquisitions. And if you've looked at his investor deck or heard him speak, he's got a number of other areas, another number of other acquisition targets that he wants to do. And this will end up being one of those companies that's probably lumpy in return. And if you look at what's happened, that's exactly what's happened is as they made these acquisitions, the stocks jumped up.
Okay. Do you expect more growth here? You mentioned he has his eyes on a couple of other projects.
Yeah, I mean, there's, both growth probably from their existing assets, because if you remember, they were buying their assets from super majors who hadn't really done a lot with those assets. And so they were neglected. And so Tenaz has been able to go in and put some capital to work and then start to really enhance the recovery of production from those facilities. And then you'll also see him make some more acquisitions. He's got a track record now and proven that he's able to do this with two significant transactions. And now that just opens up the opportunity for him to do it globally in a number of other areas. And I suspect that his M&A team is behind the scenes talking. And that's why I said it could be lumpy, because if all of a sudden they announce a deal, it will jump up, because until that's done, nobody knows it's there and it can't be really included in the numbers.
Got it. Okay, let's get to your next past pick, a familiar Canadian company, MDA Space. Which was at 36 at the time in last August, now to 40.07, 13% downside, 13% downside for total return as well. They lost a contract. I guess it was fall of last year, which hit that company hard. Has been trying to come back since. Do you still like it?
We do, yeah. I mean, again, if you kind of go back to what they do, it's, their focus is space. And as we get more private companies in that area, the cost of space continues to come down. So there'll be more participants, and that just means more business for MDA. As you mentioned, they were kind of unfortunate they lost that contract last year. Nothing to do with them. It just was kind of unfortunate. The stock really pulled back. It's since built a base and is starting to regain what it lost as a result of that.
Okay, let's leave it there for the block. We will take a quick break, lining up more of your phone calls for Bruce Campbell of StoneCastle Investment Management. Back in a moment. Welcome back. Let's go to Gulam on the line in Toronto with a question today for Bruce Campbell. Hi, Gulam.
Hi there. Good afternoon. My question is on Propel Holdings. I bought that a while ago about a month ago when it dropped significantly, but I don't see the stock. You see there any upside on the stock in the next year or so? I'd like your opinion. Thank you.
Okay, thank you for that question. Propel, has it been caught up in sort of the whole private equity concern, or what would you say is weighing on the stock, Bruce?
Yeah, I don't think it's as much to do with the private equity concern as it is just some of their comparables. So if you remember what they do, they're in lending business, and they would be, certainly higher ratio mortgages or not mortgages, loans. And these are, what would be considered back in the day was subprime lending, because these tend to be investors who don't have the best credit rating. That being said, a lot of their peers have seen delinquency rates rising, but Propel has done a really good job of managing that, and they continue to drive their numbers higher. Through their use of AI, they've been able to manage those loan delinquencies quite well, in that you actually see, if you look at the last quarter when they just announced it, they actually increase and decrease the amount of new applications that they're willing to process and look at based on what they're seeing with their delinquency rates. The stock's done, challenging here, certainly in the last year for sure, and yet they continue to produce higher numbers. And I think this is just a function of really a couple of things. One is that it just probably got ahead of itself from a valuation standpoint because they were making acquisitions and they were growing, and people get excited about where things go, and then as some of their peers had more challenging times, then the multiple started to contract for Propel. If you look at it over the next, you asked 1 year, but I think if you look at it over sort of 2, 3, 4, 5-year time frame, I think this company will continue to grow their earnings and continue to probably make acquisitions to enhance the growth of their earnings as well. And with where the valuation is now, it probably makes more sense that it can go up over time because you'll probably get an earnings increase, but you could potentially also get an increase in the multiple as well. So we don't own it right now, but we certainly have our eye on it.
Got it. Okay, let's get to our next caller. Jim's on the line. He's in Elliott Lake, Ontario. Hi, Jim.
Hi, good afternoon. I just would like to ask you about Cameco. There's been a pullback here as of late, but certainly has had quite the run in the longer term. Would you look at this as an entry point?
Okay, thank you for the question. Thoughts on Cameco? Any reason why we've seen that pullback that you can recall, Bruce?
Nothing specific that I have actually seen. I just think it made such a move, and there was such growth in money flow into commodities in all capacities, and some of that's been pulling back as far as the stock price goes. Longer term, I think that Cameco probably has a lot of runway. We know that the world's moving more towards nuclear reactors, either large ones or these smaller ones, and Cameco really is the leader, and they're one of the few uranium companies that's out there that really have revenue and growing earnings, and so as a result it's kind of the go-to place. We don't own it right now, but we certainly have to sit back and wish that we did based on the price that the stock's gone to.
Okay, so clearly you would just hang on to it.
Exactly. If I owned it, I would hang on to it, and if I was looking at a longer term piece, I would probably start to work my way in as it pulls back.
Okay. Let's get to our next caller. Then John's in Hamilton, Ontario, with his question. Hi, John.
Oh, hi. Bruce and Marilla, thanks.
Did we lose John? Is he still there?
Hi, are you there?
We hear you. Go ahead.
Okay, sorry. I'm speaking through my headphones. Thanks for taking my call. Bruce, I have a question regarding Mullen Transportation. I'm looking at adding to the transportation aspect of my portfolio. I've been looking at the stock for the last couple of months. It's gone down a little bit. I'm interested in it because it's got a healthy monthly dividend, which is kind of unique for a company like this. I want your impressions about, would you buy it? Do you own it? Would you hold it long term? So your impressions would be very much appreciated. Thank you.
Thank you for that question. Yeah, a 5% dividend here for essentially like trucking, I guess, and logistics is what they do, oil field services as well. What do you think about Mullen Group?
We don't own it right now, and this is one of the companies that anytime they report, I love to hear what Murray Mullen has to say, because he has such a great take on where the economy and business is going. If I did own it, it would be one that I would probably keep a core position in and then trade around what we would be seeing as far as the economy itself, because it does tend to be cyclical in nature because of what they do. It will track up and down with the actual economy, but they are such good operators, and they've done such a good job. Even in the tough times, they manage to make money, and then they've made acquisitions sometimes in the tougher times, and they grow. That's why I would hold that core position and then trade around it to increase my position or decrease my position based on what was happening with the economy.
Got it. Okay, let's take another quick break then. We'll get back to your phone calls in just a moment. Stay tuned. Welcome back to Market Call. Let's go to Jason. He's in St. Andrews, Ontario. He's got a question today for Bruce. Hi, Jason.
Oh, yes. Hi, Bruce. I bought Hydro Technologies last January at a 25-cent average cost. It came recommended from Jay Taylor from New York. And there's people saying it could go to $1,000 a share. I just wonder what your opinion is. Thank you very much. Bye.
Okay, thank you. Can you tell us a bit about the company, Bruce?
Hold on, I just need to say, wow, that's amazing. From 25 cents to $8, that's quite the return. So the company has a technology that is able to take, I believe it's butane, and turn it into graphene. And that graphene can be used in a number of different ways, in a number of different forms. And their technology basically causes an explosion that produces this graphene, and they have their own, I guess, reactor, for lack of a better term, that does this. And right now they have limited size reactors, but they're talking about the fact that they can make slightly bigger reactors, and then they can put these on the actual site of any user of their product, and then they would effectively sell it to them kind of right there on the spot. And that it's pure, and it's also more efficient than doing it any other format. And clearly the stock's taken off. It's over $3 billion market cap now. The thing that, there's lots of people out there on social media talking about, yes, it could go to $1,000. The thing that I, am always cautious with in a case like this is that I don't believe there's anyone that's actually seen the machine operating. And so you always have to be a little bit skeptical of like what's behind it. And, when they eventually, kind of pull back the curtain and show everyone, well, then that might be the moment. And obviously there's a lot of people that believe in it. But when you have a $3 billion market cap on, kind of what's happened, you do have to be skeptical. So if I had 25-cent stock, I would certainly be taking some profits along the way, and I wouldn't get too greedy. They just raised more money, and they did it in, a fairly significant manner, and it was gone in record amount of time. So there's a lot of believers here, and it'll be one that's going to be super interesting over the next few years, because if they have the technology and can deliver it at scale, like the market believes, then yeah, it could be significantly higher than where it is today.
Interesting. Okay, let's get to our next caller. David's on the line in Scarborough, Ontario. Hi, David.
Hi, good afternoon for taking my call. Bruce, can you share your opinion and analysis on Beyond Oil? Looks like after a brief run-up, it's pulled back to the 270, 280 range. Do you ever see this stock go up to $5 anytime soon?
Okay, thank you for the question. So they do cooking oil, I guess, but they sort of rework the cooking oil. Can you explain a little bit more about what that process is, what they do?
Yeah, so if you look at, cooking oil that's used in any number of different variety of restaurants, they have a powder that they can add into the cooking oil that effectively cleans the cooking oil. It removes a lot of the impurities. The food tastes better. It's healthier. And it means that the restaurants don't have to replace the cooking oil, which is a fairly significant input versus the powder that they produce. They've been rolling out trials with some fairly significant major quick service food restaurants across the world. And what you kind of want to see next is that they would sign a master deal probably for a bigger country or for the entire world, where those franchises then started to use that. And that's where you'll really start to see the stock move as they saw revenue and earnings start to ramp up. There's lots of people that have been following this, and the stock's done really well. And it tends to kind of go in these fits and starts where it makes a big move up on a lot of news and excitement of announcements, and then it consolidates a little bit. And where the next real big move will be is when they start to sign some of these larger, longer term contracts that all the franchisees will start to adopt the product. And then at that point in time, you'll really see their numbers from a bottom line, like earnings and revenue, start to increase, and then the stock will really move off of that.
Got it. All right, they're out of North Vancouver. Let's take a quick break. We will get to the new top picks from Bruce when we come back. Join us tomorrow for Market Call. Gordon Reid will be on the show, President, CEO of Good Read Investment Counsel. He'll take your questions on U.S. equities. Let's get to new top picks from Bruce Campbell. We're going to start with Cavi Energy, CVVY, on the TSX. They do natural gas and natural gas products as well as sulfur. Can you tell us a little bit about them?
Yeah, I mean, this is a really interesting company in that if you go back a few years ago, they were focused on doing LNG out of the East Coast. That didn't really work out the way they wanted. So they've had to do a fairly significant major pivot. And they had the natural gas assets, and then they also had the processing facilities, which is a big part of what they're doing. So they have these low decline natural gas assets, and then they have these 3 different production facilities, which allows them to really split off both sour normal natural gas and sour natural gas, and then they're able to split out the sulfur in addition to that. And so they're making money on natural gas, they're making money on the processing, and then they also produce around 10% of Canada's sulfur. And sulfur is being used more in a lot of different industrial applications, including mining, where they make sulfuric acid in order to extract the minerals out. And so this is a byproduct of their natural gas assets and their processing that they're able to make money on. And the stock's just starting to get kind of rediscovered here as the team's out, talking about what they're doing. If you go back to their original thesis, which was to build the LNG facilities in the East Coast, and it just didn't happen, they had some high debt that was based on having facilities that were going to be generating a cash flow, and then it didn't happen. And so they've had to restructure that debt, which they have, which has started to bring down the cost of financing for them. And then at the same time, they have very strong supportive ownership from an institutional standpoint, which allows them to kind of be backstopped by capital anytime they might need some.
Got it. Okay, I do have to get to your next pick, which is Neo Performance Materials, NEO on the TSX. They do rare earth, and we normally think of sort of China when we think of rare earths and magnets, those kinds of things. But this is a Canadian company.
It is. It's a Canadian company, and they actually did some work in China before, and now they're starting, especially with what China's done on the rare earth side, they're starting to move that production to other areas. So they've been producing magnets for motors for 30 years now, and of course that's a bigger and bigger area of our economy. And then they also do processing of a number of other rare earth metals as well. And if you look at kind of what they've done, they continue to produce growing earnings. They trade at a discount to a lot of their peers, and we've seen institutional ownership continue to pick up, especially now that they've crossed that $1 billion market cap area and have more attention on them than they have in the past.
Got it. Okay, let's get to your next pick, which is Kraken Robotics. They do underwater robotics. Is this a defense play for you, Kraken?
It is, yeah, for sure. That's exactly what it is. And it's kind of been one of the darlings of the Canadian market. And their specialty has really been on sonar sensors and batteries. And then they just made an acquisition recently with a company that's doing communications and monitoring and navigation. And so there'll be quite the crossover between the two. That was a profitable company. They're a profitable company. And if you look at the kind of the news releases, they continue to get more and more and more battery orders. So I think there's going to be a fair bit of cross-selling. And then, as you mentioned, it's that look into defense, where this is kind of one of the new frontiers. We've seen lots of drones in space, but we haven't seen that much undersea. And that's a big area that a lot of different U.S. or not just U.S., but a lot of different countries are focused on, and then also privately as well.
Okay, very quickly, with the run-up, would you still invest in it? You're recommending it, so obviously I guess you would.
Well, I mean, they've had a bit of a pullback here based on what we saw when they issued the stock. We participated in the financing when they did this acquisition, and so we still like it here, even though we have original cost in sort of the 60-cent range.
Got it. Okay, let's leave it there, Bruce. We're out of time. Thank you for sharing some of your time today, Bruce. And thank you for watching today on Market Call. We'll see you back here again tomorrow.